America's economy can look powerful from a distance. The markets are still resilient, wealthy consumers are still spending, and international travel by Americans remains surprisingly strong. But if you move below the headline numbers, a very different picture starts to emerge. The American economy is increasingly looking K-shaped, one side moving higher, while another side struggles to keep up. And this is where I think the Trump administration deserves serious scrutiny. As an independent macro analyst, I am not interested in whether the headline says the economy is strong or weak. I want to know who is actually benefiting from that strength, where the pressure is building, and what happens to the dollar, gold, and silver when those pressures eventually reach financial markets. That distinction matters right now because the July CPI report is due on August 12th. The latest official CPI data showed June inflation at 3.5% year over year, while core CPI was 2.6%. The Cleveland Fed's latest nowcast was pointing toward roughly 3.42% headline CPI and 2.52% core CPI for July, although those were estimates, not official results. So tomorrow's inflation number is not just another economic statistic. It could become another test of Trump's economic strategy because President Trump has repeatedly presented his policies as a way to make America stronger, richer, and more competitive. But there is a contradiction developing underneath that message. Policies designed to create economic pressure abroad can also create economic pressure at home. Look at Iran and the Strait of Hormuz. Trump has now signaled that he is willing to let economic pressure on Iran build rather than immediately launch another major military escalation. Reports describe a renewed emphasis on sanctions, financial pressure, and the blockade around Hormuz. From a political perspective, you can understand the calculation. But from a macroeconomic perspective, this strategy is far more complicated. Hormuz is not simply a geopolitical headline. It is a critical energy corridor. Any prolonged disruption can affect oil, shipping costs, inflation expectations, and global growth. And once energy costs begin moving higher, the Federal Reserve has a much harder job. This is the problem I see with Trump's approach. Economic pressure is being treated as if it only affects America's opponent. It doesn't. Markets don't recognize political borders when it comes to energy prices. If geopolitical pressure pushes energy prices higher, American households can feel it through transportation, food, and other costs. Businesses can face higher input costs, inflation expectations can rise, and suddenly the Federal Reserve has less room to respond to economic weakness. That is precisely where gold becomes interesting. Gold doesn't need America to enter a recession tomorrow. It only needs investors to become less confident that policymakers can simultaneously deliver low inflation, strong growth, geopolitical stability, and sustainable fiscal policy. And silver could become even more interesting because it sits between two worlds, a monetary metal and an industrial commodity. So the real question isn't whether Trump can claim another strong economic headline. The question is whether his policies are creating the kind of instability that eventually forces investors to look beyond the dollar and toward precious metals. The Trump strategy has a hidden economic cost. The deeper problem with the Trump economic strategy is not simply that it is aggressive, it is that several aggressive policies are now interacting with each other at the same time. Trump wants maximum pressure on Iran, stronger leverage over trade, lower prices for American consumers, strong economic growth, and easier financial conditions. The problem is that these objectives can collide. Take the latest Iran strategy. Trump has shifted back toward economic pressure and sanctions rather than immediately pursuing another major military escalation, while the Hormuz situation remains unresolved. Reuters reported that fading hopes for a Hormuz agreement pushed oil prices sharply higher on Monday, with Brent reaching around $82 a barrel and markets becoming more concerned about inflation. This is where I would challenge Trump's economic messaging. You cannot deliberately increase geopolitical pressure around one of the world's most important energy routes and then assume the economic consequences will stay overseas. Oil is global, shipping is global, inflation is global, and ultimately, American consumers pay part of the bill. That creates a difficult situation for the Federal Reserve. If economic activity weakens while energy prices rise, the Fed faces a classic policy dilemma. Cutting rates can support growth, but easier monetary policy can become harder to justify if inflation starts moving higher again. And this matters enormously for gold. Gold does not only respond to falling interest rates, it also responds to uncertainty about whether policymakers have control of the situation. If investors begin thinking that Washington is creating one economic problem while trying to solve another, demand for monetary protection can increase. But there is another issue that deserves even more attention: the American consumer. The K-shaped economy is becoming a useful way to understand why economic headlines can look surprisingly strong, while many households feel completely different. U.S. Bank describes the current economy as one where higher-income households and capital-intensive sectors are benefiting from asset appreciation and technological change, while lower-wage workers and labor-intensive sectors have thinner financial buffers. Bank of America has also highlighted the role of tax refunds, a relatively solid labor market, and the wealth effect from the bull market in supporting consumer spending. And this is where Trump's strong economy narrative needs more nuance. If wealthy households continue spending because their portfolios and assets are performing well, that can make aggregate consumption look healthy, but aggregate numbers can hide distribution. A millionaire spending more does not mean a household living paycheck to paycheck has suddenly become financially comfortable. That distinction matters for precious metals because financial stress does not always appear first in GDP. Sometimes it appears in household behavior, sometimes it appears in credit, sometimes it appears in confidence, and eventually it can appear in markets. This is why I would not simply look at the S&P 500 and declare that Trump's economic experiment is working. A stronger stock market is not the same thing as a stronger financial position for every American. And if Trump's policies continue producing a combination of geopolitical uncertainty, fiscal pressure, uneven consumer strength, and unpredictable inflation, investors may increasingly ask a different question. What happens if the government can no longer solve every problem with another policy announcement? That is where the gold story becomes much bigger than a simple safe haven trade. Because when confidence in policy starts weakening, investors don't necessarily wait for a crisis. They start positioning before it. The inflation trap, Trump cannot simply talk away. Now we come to the number that could expose the biggest weakness in the current economic strategy: inflation. The July CPI report is scheduled for release on August 12th at 8:30 a.m. Eastern Time. And this report matters because the Federal Reserve is already trying to balance two conflicting signals: economic activity that still has resilience and inflation that remains above the Fed's 2% target. Markets are expecting inflation to remain elevated, even if the underlying trend is somewhat softer. Recent inflation expectations also show that Americans are still anticipating higher prices ahead, with one-year expectations at 3.6% in July. This is where my criticism of Trump becomes very specific. Trump has built much of his economic message around the idea that stronger pressure, stronger bargaining power, and aggressive policy will ultimately produce better outcomes for America. But markets do not reward political confidence. They reward economic results. And if tariffs, geopolitical confrontation, and fiscal expansion keep pressure on prices, the administration cannot simply tell households that inflation is under control. People experience inflation at the grocery store, at the gas pump, in rent, and in financing costs. That is the difference between a political narrative and a macroeconomic reality. The danger is that Trump's policies can create a difficult feedback loop. Suppose geopolitical pressure around Iran keeps energy markets nervous. Higher energy costs feed into transportation and production. Businesses face higher costs. Consumers then face higher prices. At the same time, weaker purchasing power can slow discretionary spending. Now the economy begins moving in two directions at once. Growth becomes more fragile, while inflation remains uncomfortable. That is almost the worst possible environment for monetary policy. The Fed wants to support growth when the economy slows, but it cannot easily cut aggressively if inflation expectations begin moving higher. And markets know this. This is why tomorrow's CPI number could matter far beyond one day's market reaction. A softer number could strengthen the argument that inflation is cooling and give policymakers more flexibility. A hotter number could reinforce the opposite argument and keep pressure on interest rates. Analysts are specifically watching whether July inflation shows renewed price pressure after the unusually favorable energy price effects seen in June. And that brings us directly to gold. Gold is extremely sensitive to the relationship between inflation, real interest rates, the dollar, and confidence in policy. If inflation falls cleanly while growth remains healthy, gold could face periods of consolidation because investors may prefer risk assets. But if inflation stays sticky while economic growth becomes less convincing, the story changes. Then investors are no longer simply asking, will the Fed cut rates? They start asking, can policymakers actually control the economic environment? That is a much more powerful question for gold, and silver has another layer to this story. Silver can benefit when monetary uncertainty increases, but it also has substantial industrial exposure. If the global economy remains resilient, industrial demand can support silver. If growth deteriorates sharply, that industrial side downside becomes a vulnerability. So silver may not simply follow gold tick for tick. That is why I would be careful with anyone claiming that Trump's policies automatically mean gold and silver must rise. Markets are more complicated than that. But one thing is becoming increasingly clear. Trump is trying to use economic pressure as a weapon abroad while simultaneously promising economic strength at home. The real test is whether those two objectives can coexist. And if they cannot, precious metals may become the market's way of pricing that contradiction. There is another problem that I think markets may be underestimating: policy credibility. Trump has shown a willingness to change direction quickly when circumstances change. On Iran, for example, the administration has moved from military pressure toward renewed economic pressure and sanctions as negotiations over the Strait of Hormuz remain unresolved. The stated objective is to force Tehran to make concessions without immediately escalating the conflict further. Strategically, that may be understandable, but economically, it creates a very important question. What happens if the pressure campaign does not produce the result Washington wants? Because the longer this uncertainty continues, the more markets have to price the possibility of higher energy costs, disrupted trade, and renewed inflation. And we are already seeing that sensitivity. On August 11th, Brent crude was around $88 a barrel, while U.S. crude was around $82.45. With investors watching the Iran-U.S. standoff and the upcoming July CPI report for signs of renewed inflation pressure, spot gold was also trading around $4,410. This is exactly why I would challenge the idea that Trump's economic strategy can simply be judged by looking at the stock market. Markets can rally while risks are accumulating underneath. A strong stock market does not eliminate fiscal deficits. It does not eliminate geopolitical risk, and it certainly does not guarantee that inflation will remain under control. The Trump administration wants to project strength, but economic strength is not simply about applying maximum pressure. Real economic strength also means maintaining predictable policy, stable prices, and confidence in the country's financial system. This is particularly important for the US dollar. The dollar remains the world's dominant reserve currency, but reserve currency status depends heavily on confidence. If investors increasingly believe that Washington is willing to tolerate higher deficits, higher inflation, or repeated geopolitical shocks in pursuit of political objectives, the dollar does not necessarily collapse, but the incentive to diversify away from dollar assets can increase. And that is where gold becomes extremely important. Gold is essentially a confidence trade. When confidence in institutions, currencies, or policymakers weakens, gold can become attractive even when interest rates remain relatively high. But there is an important distinction here. I am not saying Trump's policies automatically mean gold goes straight up. That would be lazy analysis. If the dollar strengthens sharply, real yields rise, and investors remain confident in U.S. assets, gold can absolutely experience corrections. The more interesting scenario is when the market begins to question whether Washington can simultaneously manage inflation, debt, geopolitical conflict, and economic growth. That is when gold's role changes. It becomes less about chasing returns and more about protecting purchasing power. And silver brings another dimension. Silver can benefit from monetary demand, but it also depends heavily on industrial activity. That means a resilient American and global economy can support silver's industrial side, while monetary uncertainty can support its investment side. But if Trump's economic policies eventually produce a combination of higher energy prices, weaker growth, and persistent inflation, silver could become much more volatile than gold. That is the key distinction investors need to understand. So when I look at Trump's current strategy, my concern isn't that every policy is necessarily wrong. My concern is that too many economic variables are being pushed simultaneously. Trade pressure, geopolitical pressure, fiscal pressure, inflation pressure, and eventually something has to absorb the cost. If Washington cannot absorb it through stronger growth, the market may absorb it through higher bond yields, a weaker currency, greater volatility, or increased demand for precious metals. And that leads us to the final question. If the American economy is already splitting into winners and losers, what happens when the policy bill finally arrives? The real Trump test is coming. So where does this leave us? In my view, the biggest mistake investors can make right now is to look at one strong headline and assume the entire American economy is healthy. The evidence is more complicated. The U.S. still has powerful consumers, strong corporate activity, and significant government spending supporting growth. But beneath that surface, the economy is becoming increasingly divided, inflation remains above the Federal Reserve's target, and geopolitical uncertainty is feeding directly into energy markets. And President Trump is now facing a test that cannot be solved with political messaging. His Iran strategy is a perfect example. Trump has moved back toward economic pressure and sanctions because negotiations over Hormuz remain stuck. But the problem is that pressure on Iran can simultaneously become pressure on global energy markets. Reuters reported on August 11th that Brent crude had reached around $88 a barrel as the US-Iran stalemate continued, while markets were watching the upcoming CPI report for signs of renewed inflation pressure. That is the contradiction I want investors to focus on. Trump wants to demonstrate economic strength by using America's financial power aggressively. But if that strategy keeps energy prices elevated, it can make inflation harder to control. And if inflation remains sticky while growth weakens, the Federal Reserve gets trapped between two bad choices: keep monetary policy tight and risk hurting growth, or ease policy and risk allowing inflation expectations to rise again. That is exactly the environment where gold can become increasingly attractive. And we are already seeing precious metals respond to the uncertainty. Gold extended its gains on August 11th, while silver also moved sharply higher as investors positioned ahead of the CPI report and continued to monitor the Hormuz situation. But I want to be very clear. This does not mean gold and silver only have one direction. A hotter CPI number could push treasury yields and the dollar higher, creating short-term pressure on precious metals. A softer CPI number could increase expectations for easier monetary policy and potentially support metals. So the next move may depend less on the headline inflation number and more on how markets interpret the relationship between inflation, growth, and Fed policy. For gold, the bigger long-term story is confidence. If investors become increasingly concerned that Washington is struggling to control debt, inflation, and geopolitical risks at the same time, gold's role as a monetary hedge becomes more important. Silver is potentially even more explosive because it has two engines. One is monetary demand. The other is industrial demand. If global growth remains resilient, industrial consumption can support silver. If monetary uncertainty increases, investment demand can add another layer of support. But that also means silver can be more volatile than gold when the economic outlook changes. And this brings me back to Trump. My criticism is not that every Trump policy is automatically wrong. That would not be serious analysis. My criticism is that the administration is taking increasingly aggressive policy positions while expecting the economy to absorb the consequences without major damage. That is the assumption markets need to challenge. Because America cannot indefinitely have strong growth, low inflation, rising fiscal pressure, geopolitical confrontation, and effortless monetary stability all at the same time. Something eventually has to give. And if the economy begins to weaken while inflation remains stubborn, investors may stop asking whether Trump's policies sound strong. They will start asking whether those policies are financially sustainable. That is where I believe the next major gold and silver opportunity could emerge, not from one CPI report, not from one Trump announcement, but from the growing realization that America's economic strength may be much more uneven and much more fragile than the headline numbers suggest. If you want to understand where gold and silver could move next, watch three things very closely: US inflation, the Hormuz oil shock, and Washington's fiscal trajectory. Because if all three begin moving in the wrong direction at the same time, the precious metals story could become much bigger than a normal safe haven trade. And as always, this is macro analysis, not financial advice. Do your own research before making any investment decision.